From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for Thursday, July 2nd, 2026. On today's show, we've got Tom Papenfus, Dave Sandstrom, Adam Baley, and looking back at the week, here's Kyle Tetting.
Well, thanks, Max. Holiday shortened, 4th of July holiday shortened week. Happy birthday, America, America 250. But an opportunity on the 1st of July as we record this to look at some mid-year returns. And I think just a reminder of how exceptional of a start to the year it has been. The 6-month return, including dividends for the S&P 500, up 10.21%. It's really, truly been a strong start to the year. Dave, not without some volatility, though, right? We have certainly seen some stretches here this year where we questioned, okay, is this the point when the market's finally going to turn south for good? And yet here we are at the midway point, and it's been another really solid year.
You know, Kyle, you walked in the door talking about conversations with some of our younger employees and what really drives the markets over long periods of time. And, of course, that answer is earnings and interest rates, which you've heard on this show many, many times in the past. But the point is, you look at where earnings are mid-year right now after the first quarter was record-setting. We follow that up with another north of 20% likely earnings increase year over year. Right now, FactSet is setting the year-end total in the 24% range. I mean, these are numbers that are just really on that upper echelon of almost record-setting. So when you take that into consideration, even when you have things like a war going on, you have a big oil shock happening, fears of inflation, I think investors have really kept their eye on the ball, and that is where are earnings at?
You know, this year it reminds me of the old Wall Street phrase, not that I like to quote them, but the market climbs a wall of worry. And we certainly have, and we've had a lot to worry about this year with the war in Iran and then surging oil prices, surging inflation, higher input costs, higher borrowing costs. But even still, earnings continue to grow. And we started out this year, corporate earnings were expected to be up somewhere around 12, 13, 14% when we started the year. And Dave, to your point, they're up substantially higher. Earnings expectations could be in the 20% range, give or take. And that's corporate earnings. But what about interest rates? Interest rates still about where we were when we started the year. 10-year Treasury, give or take, on January 1st, about 4.5%, and that's where we are today. Even with some higher inflation, borrowing costs remain relatively steady, so higher earnings, stable interest rates, and that's allowed the market to get to where we are today.
You know, on the earnings front, I think it is so interesting that the typical path is these very optimistic forecasts. We turn around and walk them back a little bit, maybe a lot sometimes, and investors wind up going, well, okay, it was good, but maybe it wasn't as good as what we quite expected. I think the difference this year has been we started with some strong but not exceptional earnings forecasts at the beginning of the year, and they've been walked much, much, much higher than maybe where we were aiming. We were talking 6 months, a year, 18 months ago about 2026 being a low double digits earnings year, maybe 10 to 12% if we were lucky, maybe a little more. And now, again, Dave, to your earlier point, we're talking 24, 25, maybe it looks better. And it's been a year in which that expectation has kind of continued to grow, in part because of the spending we have seen, the cash that has truly been spent in this artificial intelligence build-out, making its way beyond just the tech sector. And Tom, I know one of the things you and I talk about a lot, and I've heard you talk about on the podcast a lot, is some of the dispersion that we see within the market. And you look at the first quarter returns and go, well, the winner was the tech sector, so it must be more of the same, right? That the market's being led by this small number of stocks. But I think maybe it goes a little deeper, right? There is some other stuff going on in the market right now.
Yeah, I think it gets less talked about right now and less advertised, but there are a lot of other companies and as such a lot of other indices that are doing quite well this year, and they are kind of pushed to the side. You look at the Dow Jones Industrial Index is having its best year since 1991. Lump that in with the Russell 2000, a broader index of smaller, mid-sized companies, also in that same camp, having their best start to a year since 1991. And those are generally signs of an economy that's doing pretty well. It's kind of a barometer for how things are going overall. And so it's just one of those, concepts that you don't have to feel like you have to, if you're worried about AI, maybe you just don't like it for personal reasons and you have some fears over it. There are many other areas of investing right now where you can achieve great returns. Let's not forget outside of the U.S. You look at the developed world index, I think very comparable returns on a year-to-date basis relative to the S&P, and far more robust returns coming from the emerging markets index out there. So you can really have a broadly diversified portfolio and really achieve really nice returns so far.
That's one of the things that I noticed in client accounts. I think clients notice as well as you look where have your returns come in this past year. Some of it has come from the AI build-out in those large technology businesses. But goodness me, you look back at the rolling 12 months for some of your non-U.S. stock funds, your global stock funds, they have done very well, in part because there's some profitable businesses still trading at reasonable prices. But the other piece has been the dollar, where the dollar has fallen considerably from where it was. It's rallied a little bit as of late, but it's still down from where it was. And a falling dollar might work against us as U.S. travelers abroad because it's a little bit more expensive. But us as U.S. investors in overseas businesses, now it becomes a tailwind because all of those revenues and all those foreign currencies are worth a whole lot more in dollars. And that's one of the contributing factors on why non-U.S. has done well and why we're still finding some opportunity there.
I think as we look at non-U.S. as well, there are certainly businesses that are cheaper than what we can find here in the U.S., Adam, right? And so it's not, certainly the dollar has been, especially in the last year, a huge part of the driver of return. And there have been some very strong returns. Local currency for ACWI ex-U.S., which is just kind of the all-country world index outside the U.S., 32.89% in the last year. That's stripping out any dollar translation, right? And if the dollar is a little bit weaker now than it was a year ago, that's even more return coming our way. But a big part of the reason for that outsized return is just how cheaply we were able to buy some of those businesses in the rest of the world. And it's an interesting thing to say this week as we head into the 4th of July, and I think so much of the focus is on our country and patriotism here. But the reality is there's a lot of great businesses in the rest of the world, too. I think some businesses that maybe you can't get here, right? If you want exposure to maybe the development in the French economy, well, you can't buy a U.S. Energy company and get exposure to France. You've got to buy Total. And so I think there is some benefit beyond just simply currency, how cheap the stocks are, to, okay, we also get some unique sources of return, some differentiation, some diversification away from just what we're doing here in the U.S. And then I think you look more broadly, even within the U.S., at where are returns coming from. It isn't just 5, 7, 10 names anymore. And I see that as simply as looking at, well, the best performing sector in the first 2 quarters of the year was technology. But the worst two were communication services and consumer discretionary stocks. There's a lot of similar names between tech and those other 2 sectors, and yet the return has been massively different. And it really is because I think investors right now are looking at businesses and what they have to pay for those businesses and trying to back into, okay, are we willing to pay up for that tech business right now, or maybe now's the time to be selling into it to buy something else?
Kyle, it's interesting. I think part of this broad-based participation is really reflective of the fact that artificial intelligence is not necessarily sector or industry specific. Productivity gains are being achieved at just about every business across the country. Tom, to your earlier point, small companies, also some of the biggest recipients of that productivity. You got a lot of small businesses across the country that can employ artificial intelligence applications, and they can make themselves look like some of the bigger companies out there, and bringing in just tremendous increases in their profitability.
And maybe that is the next leg in the artificial intelligence trade or build out, or its path ahead. For the last 5 years, I swear we've been talking about like the development of that technology, and now it's more about the implementation of that technology, and not just like selling the servers or the computer chips that the software runs on, but now it's about those small industrial businesses that say, hey, we can use this technology to be more productive or more profitable. It's about the implementation of that, and you start to see that in small caps are doing well and industrials are doing well, maybe because they're finally starting to implement this and find some productivity gains there.
Yeah, maybe this is where I get to stand on my soapbox just a little bit and tout just how great this country is. And again, ahead of the 250th anniversary of our independence, I think appropriate to point out that it wasn't necessarily the political system, the politics, the politicians that have made this country great. It truly is a lot of these businesses we're talking about right now that over the last 250 years have found these immense opportunities to problem solve, right? That if you can take some issue that's out there, get some capital from investors as a way to develop some technology, some process, some service that can solve those problems, well, all of a sudden, you've got a business, and potentially you've got a business that can be very profitable. And as you look at some of the demographic issues in our country right now, some of the broader problems that might be out there, what better way to solve some of those issues than to make us more productive? What better way to get to some of the underlying issues than to say, well, maybe AI and automation and robotics are part of the solution to that problem. As an investor, that's why I'm putting my dollars where I put them, because we are truly looking to solve some of those problems. And then, Adam, I know inflation being one of the big things that's driving interest rates. Well, we have a Fed governor now that's pointed out that technology tends to be disinflationary.
Yeah, and gosh, it feels like Chairman Warsh was almost quoting Alan Greenspan. And if you go back to like the late 1990s, one of the things that Alan Greenspan was really known for was noticing something brilliant in the economic numbers back then, which was that if you had all of these huge productivity gains, there's more output per man-hour work, you could pay your employees more. But because output was higher, you didn't have to run the risk of surging inflation. And that was the connection between higher productivity gains, but maybe not the inflation worry that we once thought. We saw that play out in the 90s. It's one of the things that Alan Greenspan was known well for. And we're starting to see some echoes of that with Chairman Warsh this week when he was speaking to the public.
You know, I think it's interesting that Warsh has kind of made clear he's not interested in forward-looking guidance. He's made clear that maybe the Fed's role is to be much tougher on inflation more quickly, but also not necessarily to bow to, well, we're going to give you all the playbook for how we get there. And yet, so far, he has been fairly forthcoming in the things he's paying attention to. He's been fairly forthcoming in, here is some of the things that I think are concerns. And at least right now, perhaps, Dave, it means that the expectations for rate cuts and potentially near term, the expectation for rate hikes in both directions may be misplaced for a little while.
I think it's important to understand that not all inflationary pressures can be beaten down or combated with Federal Reserve rate hikes. You know, there's things like what we're experiencing right now. You get a shock in the oil markets, for example. All the Fed intervention in the world is not necessarily going to change that inflationary pressure. Those are outside forces that the Fed has no control over. No different than the bird flu affecting egg prices, right? I mean, those are things that Federal Reserve rate hikes don't combat. You know, we are seeing a little bit of this across all economies right now across the world as we see oil prices retreating a little bit. We've seen inflation in Germany and France and Italy recently all coming down. So this is a global trend where we're seeing a little softening on that inflation number. So I think it is appropriate for the Fed right now to maybe tread water for a little bit and not overreact too quickly.
It's just as a reminder, their mandate, the Federal Reserve, at least here in the United States, they have a dual mandate. One is price stability. The other is job stability. And we've gotten some job market data this year. It's certainly healthier this year than it was last year, where we had a handful of sizable job losses throughout the fall of last year, but some more stability here. So maybe perhaps they're meeting their mandate on job stability, but prices continue to rise. Inflation remains an issue. So they're probably going to hit the pause button for now and let the data roll in, and they're still going to be data dependent. But my hunch is that the next rate change they make might be a raise, not a lowering, but I think they're going to wait a good long time before they make that ultimate decision.
Yeah, and I think they can, right? You're in an environment in which things have been shifting fairly rapidly, but the things you care about, the inflation piece, yeah, your policy is not going to have that much control near term, and long term it may be a problem that's self-solving. And the labor market, by and large, has been strong enough. And I look locally, there was an announcement this week. The first time in 3 years, the state of Wisconsin had not a single layoff notice for the month of June. That's a big deal, and I think it speaks to a bigger story about how the labor market in our country has been strong enough, again, not strong, but strong enough to not be the problem that the Federal Reserve has to focus on. And so I think as we look at kind of the economic landscape, well, if I'm the Fed, I'm not terribly concerned about the labor market, at least yet. I do have some concerns about inflation, but until there's something that my action is going to help prevent, well, I can kind of stay in that wait and see. And Tom, for the bond market, such a big part of our portfolios, it's meant that, yeah, rates came up a little bit so far this year. Our bond portfolios maybe not up the 2.25 or 2.5 we might have hoped, but been happy that bonds have treaded water. And maybe as we get into the second half of the year, if rates can stay steady, there might be a little more opportunity for fixed income investors.
Yeah, I mean, the fact that we are slightly worried about interest rates and ultimately inflation does mean that perhaps those yields on our bond portfolios remain higher for where they're not immediately coming down. The trade-off, and we've always talked about the inverse relationship between prices and interest rates and how that can be a nice tailwind for those bond prices. But if rates are going up, and they're going up perhaps maybe a little bit steady, we can expect greater yield, greater income from those bond portfolios, and even your demand deposit accounts. I'm starting to see it tick up personally in some of my savings yields that I'm seeing. So for a lot of our clients who happen to be income focused, retirees, not necessarily the worst thing. And now maybe if we do see rates that are steadying, we can just focus on that income component, and that can generally be looked at as our return for the year.
And I think what's interesting too, Tom, is that we came out of a very, very unusually low interest rate environment for many years following the financial crisis through the pandemic. And what happened is during that time, when yields fell that low, you lost that cushion, that shock absorber, so to speak, to protect you against price movements in the industry or in the market. Right now, with 10-year, Adam, you pointed out about 4.5%, we have that cushion again. So we can absorb a little bit of a price fluctuation without feeling the pain, and bonds can continue to do their role and play that safety piece of your portfolio.
I'll take that a step further. I think the fixed income market is offering some very compelling returns to stocks. I mean, the safer areas of the market, whether it be cash or high-quality short-term bonds, they're offering some compelling returns on cash these days. You can still get somewhere between 3 and 4% on cash. 10-year Treasury, like we said, about 4.5%. A similar credit quality corporate, maybe 5.5%, give or take. And you can't dismiss some attractive yields on bonds these days. And you're right, you go back for the last 10, 15 years, and investors remember getting 2% on a bond fund, and now maybe you're able to get 5.5%. You get a lot more cushion, a lot more yield, and some more competitive returns to stocks these days.
Adam, you wrote a pretty compelling piece a couple of weeks back for our newsletter pointing that very thing out, and I'll tell you, it's probably one of the more engaging pieces we've put out there, in that I've gotten a fair number of responses from clients going, okay, so what are we going to do about it, right? If the opportunity set, and thank you, by the way, for the interactions that maybe were forced, but I love having those conversations because I think it speaks to, okay, this is constantly shifting. It is not as if we set this and then never have to look at it again. And to the point you make in the article, and to the point you just made, we do have to be more cognizant of maybe there is some better opportunity in safer money right now, but to what extent? And it might mean a portfolio that was once 65 or 70% in stock when stocks looked really, really cheap through the teens, even into the early 2020. Maybe now that portfolio looks a little closer to 55 or 50% in stock, in part because, well, maybe you're 5 or 6 years older than you were the last time we looked at this. And in part, I think, to your point, because, well, the opportunity set has shifted.
Yeah, and in my article, if you haven't read it, for anybody who's listening, go and read it. It's worth 2 minutes of your time, but it talks about the earnings yield on stocks relative to the earnings yield on bonds. And current earnings yield on the S&P 500 is about 4.5%. Current yield on the 10-year Treasury about 4.5%. Those are essentially the same. And that's usually not the case because investors historically have demanded a significantly higher premium to put up with the volatility of stocks. But here we have today the expected return on ultra-safe government bonds mirroring that of stocks. So for me, it begs the question, well, should we be taking take that extra unit of risk in stocks or not? And at this point, when the relative value just says, well, maybe not, maybe we can just look for some more consistent returns in bonds and fixed income. It's not about like all stocks or all cash or all bonds or anything like that. It's about where do we take that extra unit of risk? Is it worth it to take? And it really helps to reframe the perspective on risk and return.
Yeah, I think next week we can spend some time on the master's level concept of marginal utility, right? What do you get for that next unit of risk? And I think that's the exact right way to phrase it, Adam, is, yeah, okay, it doesn't mean one or the other, but it means if I'm thinking about what happens with my next dollar, well, maybe the next dollar goes to safety because I'm getting paid enough for it to go to safety, and that's not always going to be the case. With that, we enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.